What goes up must come down, and that seems to be the prevailing sentiment as 3 days of lackluster trade has bulls sitting nervously on their longs. But what about oil? It shot up 4% in an epic short squeeze as the dollar erased its entire 2023 gains. But does this provide a great entry for those that want to hold dollars as the deflation narrative takes hold? Today, we discuss deflation and what it means for the market in 2024. Do we take profit and rotate into deflation hedges, or do we continue along the path of least resistance? Hello, ladies and gentlemen. Welcome to the Daily Recap Show, where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Options expiry makes for no rhyme or reason. We had some of the technology names lower, other of the Magnificent Seven names higher. Energy as a whole performed really well on the back of oil prices. Regional banks put in a really good day, but looking at the sectors more broadly, very healthy movement, especially in the 5, 20 and 50-day moving averages for pretty much all the large cap stocks except for energy. But compared to yesterday, it was a stark difference. This was all on the back of oil prices. Oil prices shot up 4% after yesterday's 5% sell-off. Very volatile movement here in energy. We saw WTI rise by 4.1% and Brent by 4.12%. And this was mostly on the back of a dead cat bounce short squeeze. And we do know that hedge funds are massively short oil. And maybe the reason why this short squeeze happened was taking profits, as well as some hedge funds who entered late in the trade, maybe just getting squeezed out and exiting the trade. And we do know that the oil trade has more of a macro fundamental basis. Negative sentiment is increasing because the global demand outlook does not look great. But negative sentiment did not stop equities from rallying. The fear and greed index touched green for the very first time since early September on the back of some great breath. The Russell 2000 was up 1.35% today. It was the leader amongst the entire market, but it was broad-based buying in small caps and mid caps. Look at the Russell 2000 index up 6% for the week. The Russell 2000 growth, Russell 2000 value up 5% and 6.2% respectively. And also regional banks, the KRE making a comeback, a strong comeback, recapturing the 200 daily moving average. And last time it was above the 200 daily moving average was just at the start of March, right before the SVB banking crisis. So very broad-based buying in the small caps, in the mid caps has been happening this week. All of the indices are up, especially the small caps. Treasuries as a whole across the curve fell. You know, the 1 month, 2 month, 3 month just a couple weeks ago was trading at about 5.55. It's now close to 100 basis points lower. But treasuries as a whole on the day did move up, but it's much lower on the week. Now, I am particularly interested in the 20-year treasury. It has the highest yield among the longer duration, and there's also a 20-year treasury bond auction happening on Monday, and this is going to be really interesting. How the market takes this auction is going to determine where the market goes next week, especially in Thanksgiving week, which is generally a low volume week. We have Thursday as a public holiday and Friday is a half day of trading. That being said, earnings this week showed us that the consumer is still on track. Home Depot up 7% on really good earnings. Target up 20% on really good earnings. And it has been a very average earnings season. We have a beat rate here of about 66%, 2,000 beats, about 1,000 misses, and earnings growth has been solid. So the SP 500 has seen earnings growth of 4.3% so far for this quarter for earnings. Just last week, we were at 4.1%. So we have seen a 0.02% increase week over week. This is very constructive for earnings moving forward. These earnings have also been paired with deflation talks. Disinflation or deflation has really been circulating Twitter, has really been circulating the earnings calls lately, and companies are expecting this and seeing this in their prices right now. And I put this on Twitter. Let's have a look. So go ahead and follow me on Twitter here, guys. Link in the description. Now, I said that there was a noteworthy development. Year-on-year CPI excluding shelter stands at 1.5%. Last month it was a 1.6% annualized. The last 6 months 1.6% too. These figures include food and energy components, and this is likely a true representation of inflation experienced by the majority of US households, because 66% of them are homeowners. And this is why a lot of people are saying that the Fed have overshot their targets, because shelter is a big component, but including everything else except shelter, we're at 1.5%. And on the back of this, we could be seeing an early rotation into deflation hedges. Now, what are some deflation hedges? Well, it's investment grade bonds, defensive stocks, consumer goods, dividend paying stocks, as well as just cash. And if you actually have a look at the best performing stocks this week, we have real estate, the best performing sector, as well as XLU outperforming the SPY. And if this narrative of deflation continues, it makes a very good argument for even more than 150 basis point rate cuts next year, which further makes the case for long bonds. And this is the Fed fund rate futures. Based on the futures, we are expecting about 4 rate cuts next year, getting to an effective rate of about 4.19%, with the first rate cut coming in about March, maybe May, a 30% chance of a rate cut in March, as well as 50% in May. But if we actually look at the more up-to-date futures, there is a chance of a 10 basis point rate cut in as early as February. And this is positive for bond prices. I've been showing you guys this chart all week. I just want to keep reiterating that if we had to get 150 basis point rate cut in the 20-year, we're expected 26% return, 33% return in the 30-year. Now let's move into stocks, and this is the seasonal chart we've been looking at for the better part of the last month. And this was our trading day today, and we could see that we are expecting a pullback towards the 24th of the month of November, but somewhere between the 21st and the 24th, we are expecting some form of a pullback into November before we rally through to the rest of December. Now, diving deeper into Thanksgiving week, the SP 500 performance since 1987 to 2022, we can generally expect a return of 0.43%. And this week, the Thanksgiving week has been 22 times up, 14 times down. The median return has been 0.15%, and we do know why it's not a very positive or flat week, because the week after OPEX tends to be a very soft week, and that's because dealer flows called Vanna and Charm are just not in the market. They're essentially on holiday, and this occurs from about OPEX all the way to the end of the month. And we do see these flows come back into the market at the start of the month. Now, let's hop on the charts and have a look at the SPY. So the SPY put in a pretty good week this week. It was up about 2.5%, a lot of which was just a gap up on Tuesday on the inflation data. Zooming in, we've left quite a number of gaps in the index right here, especially on Tuesday when we gapped up heavily. We saw fairly balanced trades today. It was OPEX, so fairly high volume. It was just a bunch of dealers rolling off their hedges and a bunch of gamma expiring. We saw a mild up day in the S&P 500 in the SPY. We do know that all of this gamma right here, which is a lot of gamma, expired, and it's going to be really interesting to see where this call resistance positions itself. Intraday, it actually moved up to 4525, but we have to get the full picture on Monday open, Tuesday open, just to see where it actually positions itself as the gamma keeps building into the first and second week of December. If the call resistance keeps moving up from this 4500 level, 4525 level to maybe 4600, and if we could get to as high as 4700 maybe, that's going to be very, very bullish. But if it starts to move lower below this 4500 level, that could be very, very telling for what could come in December, especially because we have had a significant rally in November. So we're going to keep an eye on this. It's very important, especially the amount of gamma that builds up, both positive gamma and negative gamma. Moving to some dark pools. SPY, big trades happening at end of day, nothing too significant. Now SPY, there was a huge trade happening right here, but nothing too significant. If we do see some sell side into next week, could be expected. It's OPEX week, dealer flows are not there. So what we really want to do is hold the 446 level and potentially the 442 level on the SPY. Those are going to be key levels. Anything lower, it could be very, very bad, but there is a ton of volume, as you can see from the volume profile. You know, the 441, 442 level should hold into next week. Looking at the Qs, huge trade came in. This was the, I believe, a 1 month chart. The 57th biggest trade since inception. It could be, I think, longs being closed off here. Do I think institutions are going to short into this? Possibly, yes. We have run up a long, long way, but you don't really want to fight the trend. I think a lot of people are just taking profits at these levels. Looking at the TLT, we didn't see any trades coming at the end of day, but we do know that there's big trades, especially buy trades sitting at these levels. And we're watching the 88.50 level as a key resistance looking forward at least 3-4 months into 2024. If you like this video, please subscribe, give me a like, hit the notification bell, guys, leave a comment. You know I love you guys.